Hello everybody, welcome back to another valuation investing video. And today in this video, I'm gonna be going over UnitedHealth stock once again because ever since their recent earnings report, the stock keeps tanking and we can't seem to find a bottom on the stock. So in this video, I'm gonna be going over when we could potentially see a bounce and if we ever will see a bounce in the stock. Then I'm gonna be getting into the financial health of the company and using my intrinsic value calculator to see at what price I'd be willing to pay for UnitedHealth today. And with that being said, taking a look at the last trading day of UnitedHealth, we can see the stock was down another 4.72% on the day. It's all the way down to $237. Keep in mind the stock was over $600 not even 1 year ago. So the stock is down almost 60% in the past year. This stock can't seem to find a bottom, and it seems like this is the case for every health insurance company right now. This industry is just doing terrible this year because of higher medical costs throughout the entire industry and less government spending. So with the recent earnings report, I want to take a look at some of the highlights and lowlights of this earnings report. And take a look at this, we see the revenue growth rate was actually still very good, where they reported revenues of nearly $112 billion, which was a 13% increase over the prior year, reflecting growth across UnitedHealthcare and Optum. So the revenue growth of UnitedHealth continues to grow at almost an increasing rate. So this is still very fast growth with UnitedHealth, especially for how big this company is. 13% increase year over year is very fast, especially for this industry. But the biggest problem is the earnings per share, which keeps decreasing because of profit margin problems. And taking a look at client retention at Optum RX. Optum RX maintained high client retention consistent with past years, with revenue growth of $18 billion or 13% and earnings growth of over $200 million or nearly 4%. So like I said, the revenue for UnitedHealth continues to grow. The sales keep growing over time, but the problem is the amount of costs this company has, which is really hurting the company's profit margins, resulting in net income decreases. But at least Optum RX is still growing at a 4% rate. Now, commitment to reform and performance. This is the biggest problem, and hopefully if they can do this, I could see a big bounce in UnitedHealthcare within a year. The company is undergoing a cultural shift emphasizing reform, transparency, and performance improvement, with extensive management and operational changes initiated. So with these changes, I really need to see changes that are going to help the net income of the company and increase this profit margin back up. So with that being said, these were the highlights from the earnings call just about a week ago, but now getting into the lowlights of this earnings call, which is the Medicare pricing and cost challenges, which I've said the cost challenges is really affecting this company. The company faced a $6.5 billion increase in medical costs. So this is a huge increase in medical costs with UnitedHealth, the $3.6 billion in Medicare and $2.3 billion in commercial business due to underestimated medical trends. So the problem with UnitedHealth is they're trying to get as many customers as possible, and then they're pricing their premiums wrong, and now they're really getting hurt as a result of more medical costs in the industry, where they're going to have to be paying more and more, which is terrible timing on UnitedHealth's part, which is causing this pain with the stock and their earnings. And Optum Health performance decline. Optum Health earnings in 2025 are approximately $6.6 billion below expectations due to mix of enrollment, accelerated medical trend, and executional challenges. So Optum Health, which is basically their technology and analytics side of UnitedHealthcare, is seeing a pretty big drop in their earnings, which is not good for UnitedHealth. Also, Medicaid trend pressures. Medicaid experienced elevated trends, particularly in behavioral health, pharmacy, and home health, leading to anticipated negative margins in 2026. So this is really not good for UnitedHealth. Medicaid, they're expected to lose money in 2026. So this is really not good for the cost of the company. And also the value-based care margin compression, significant revenue hit from V28 transition with value-based care margins expected to remain at 1% in 2026, reflecting a slower recovery path. So the biggest problem, like I've been saying basically every video with this company and in this video, is just the medical costs and their terrible timing with these costs. There's all of a sudden unexpected costs in the industry, and it's really hurting all of these companies. Taking a look at the company guidance for the Q3 2025, we can see UnitedHealth revised its 2025 adjusted earnings outlook to be at least $16 per share. So that's a pretty big decrease over the past year, and expects full year revenues to approach $448 billion, reflecting an 11% growth over 2024. So the revenue growth is still increasing at double digits, yet the earnings per share for the year is going to decrease. So once again, the big problem is the profit margins, and see right here, full year medical care ratio of 89.25%. So this is the amount they're spending on customers, and their average is about 80 or so percent, and their all-time high medical care ratio was 85.5%. So they're at a very high medical care ratio, and this is the highest they've ever seen. And they anticipate this to be right around there for the upcoming year. So that's not very good. But I would like to add, the company said they have a strategic focus is on margin recovery, with plans to achieve 2 to 4% operating margin range in Medicare by 2026. So they're going to try and get this Medicare margins up greater so they don't lose as much. So that, if they can do that, then I think this company can get a good rebound in the stock price. But taking a look at the net profit margins for UnitedHealthcare, we can see over time it was kind of increasing since 2016. Over time, it was up to almost 7% net profit margins, but it's been around 5 to 6% right here. But as we can see in 2024, we saw a huge drop, then a little rise back in last quarter, but right now we saw a big decrease, and right now the profit margins are right about here, right near 3%. And they're expecting this to keep going down over time, probably to be at like 2 or so percent, because analysts are very bearish on this company with the profit margins because of the high medical costs. And taking a look at the earnings of UnitedHealth, we can see over the past few quarters, it's increasing basically every quarter. But in quarter two, which they just reported, it tanked all the way down from $7.20 to $4.08. So this is about a 40% decrease in their earnings per share. And then now they're expecting $3.35 in the next quarter. This is another about 20 or so percent drop in earnings per share. So the earnings per share is really just taking a hit, while the revenue keeps increasing over time right here. See this? The revenue every single quarter has, I think, increased. So this is good for UnitedHealth, and they're expected to report over $113 billion in revenue next quarter. And taking a look at Optum, which is a company that UnitedHealth actually owns, this company uses market-leading information, analytics, and technology to yield clinical insights. Optum helps improve overall health system performances by optimizing care quality, reducing care costs, and improving the consumer experience. So they offer analytics and stuff like that for businesses to help serve patients. And taking a look at Optum Health, full year 2025 revenues for Optum Health are expected to be $101 billion to $101.6 billion, a decline of 4% over 2024. So that's not good for Optum. And also taking a look at the earnings from operations, they're expected to be $3 billion to $3.1 billion, and the full year operating earnings margins is supposed to be 3 to 3.1%. So basically a reduction in almost everything with Optum Health. And taking a look at the Optum Insight, which is the full year 2025, revenues are expected to range from $19 billion to $19.5 billion compared to $18.8 billion in 2024. So Optum Insight is continuing to grow over time, and also the margin is estimated at 18.2% to 19.2%. And then taking a look at Optum Rx, we can see the full year 2025 Optum Rx revenues are expected to be $151 billion to $151.5 billion compared to $133.2 billion a year ago. This increase is driven by a strong growth in customers and people served across the company's integrated pharmacy service offerings. Earnings from operations are expected to be $6 to $6.1 billion. The full year operating margin estimated at 4%, and adjusted scripts are expected to be 1.67 billion. So this means Optum is actually doing decent. Optum Health isn't doing good, but Optum Rx and Optum Insight is kind of carrying the company's growth rate a little bit in the earnings department because of the increased cost for UnitedHealthcare with Optum Health and their insurance side of the business. But taking a look at insider trading volume, which can give us a sense of whether or not we should be buying this company, because if a lot of insiders are buying, it is very likely that we should be buying, because the insiders know best, most likely, because they want to make money too. So taking a look here, UNH insiders have bought more shares than they have sold in the past 3 months. We can see only one person has sold, and they only sold 500 shares. But in insiders, they bought 109,000 shares. So 5 people on insiders bought shares, and they bought a lot. So that's good for the company and showing more confidence. And also, even showing more confidence is the buybacks UnitedHealth is doing, where they're buying back almost 2% of shares just this quarter. So they're really starting to buy back shares, and this shows even more confidence in the company, where they're going to be buying back shares, meaning they think this company could recover in the future, where I think this company will definitely recover. But I think the key question is, how fast will they recover in stock price? And seeing over here, they really weren't buying back shares until this time right now. So this is one of the most times they've been buying back, which is giving me more confidence in the company. Taking a look at the 7-step stock analysis for UnitedHealth, these are the 7 metrics that I like to look at the financial health of the company. This gives us a nice overview of the financial health. And taking a look here, we have 6 out of the 7 metrics hit with a check mark, and the P ratio pretty low, greater than 0, meaning this company is profitable. And the forward P ratio is also very low, less than 30. So these valuations shows us that it's pretty undervalued. These valuations shows us that you're paying a very cheap price for UnitedHealth, but it does make sense because the earnings per share keeps decreasing over time, and the PE ratio is likely going to go up to potentially 15 to 20 because of the reduction in earnings per share, so it does make sense. Now for the revenue growth and EPS growth greater than 5%, we can see they're growing at 11% and 13% over the past 5 years. Also, the buybacks are there. They're decreasing at 1% each year. The debt-to-equity ratio is slightly high with a 77%, meaning compared to their equity, they have 0.77 times in their debt. So at least they don't have more debt than their equity. And the expected EPS growth rate by analysts is 9% over the next 5 years each year. So analysts still expect this company to grow pretty decently over the next 5 years. So that being said, looking at my intrinsic value calculator, I'm going to try and calculate the fair value price of UnitedHealth and to see if we should be buying the stock today. So with the future annual revenue growth rate, I think UnitedHealth could probably grow at 7% over the next 5 years. And I think this is actually pretty conservative, especially with them growing at 13%. They were growing 13% over this past year, so 7% is still a pretty low number compared to what they're doing. But the hardest part is looking at the future profit margin, in which, as we saw with their recent quarter, their profit margins tanked to 3%. While their profit margins were at 5 to 7% over the past 5 years, it's really starting to decrease. So you got to think to yourself, do you think that UnitedHealth can recover in the next 5 years to get back to their profit margins that they were at for the past 5 years? I think that they can recover, but to be on the safe side, I'm going to say 4% profit margin. Now for the future PE ratio. The future PE ratio, I think this company isn't an above average company in terms of revenue growth and profit margins. And I think the insurance business is a little bit more of an undervalued business just because that's how it is, and it's going to stay like that. But the PE ratio of UnitedHealth has been anywhere from 10, which it is today, all the way up to 25, in which I'm going to be a little more conservative here, because with the 7% revenue growth rate, that's about half the average S&P 500 company. That's about half of the S&P 500, because companies like Microsoft, Meta, Amazon are still growing at 15 to 20% revenue growth numbers, in which if we do assume that they're going to grow at 7%, I think a fair P ratio could be 15. And now for the shares outstanding, I think they're going to buy back about 1% each year, because that's what they've been doing, and they could potentially even be buying back more. And say they bought back about 1.5%, because they're really starting to buy back now. I think if you bought this stock today, you can make about 11.46% on your annualized return, and I get a future share price in the next 5 years at $408.97. With the current price at $237, I think this looks like a pretty decent time to buy. But me personally, I'm waiting until we get any signs of recovery in the company, not the stock price. If we see the stock price rally and say the company hasn't said anything, then why would you buy in? We have to see the fundamentals of the company start to at least get a little bit better and not decreasing at fast rates. But say we go to the revenue growth rate, and as they're growing at 13%, let's do a bull case for UnitedHealth. Say they are growing at 10% over the next 5 years. They've been growing at about 13% each year, so I think that could be achievable, and this is my bull case. Now for the profit margin, say they get up to 5% and a future PE ratio of 17, we could see a potential future share price in the next 5 years at $665 per share and a total annualized return of over 22%. So if you think they can continue to grow at 10% and have the future profit margin get back to what it was, then this looks like a good time to buy. But say we meet in the middle between 3 and 5% and even put the future P ratio at 15, I think you can make almost 15% on your investment with UnitedHealth still. So with that being said, like I said, I'm just going to be waiting this out just a little bit to see what the company has to say maybe next quarter or just within the next few weeks. Maybe I might be adding to a starter position maybe, but I'm not sure yet. So with that being said, thank you guys for watching this video on UnitedHealth once again. Please subscribe, hit the like button, comment down below, give me some feedback on this video and what you thought of it, and thank you guys for watching. See ya.